So how does insurance work? Health insurance creates a third-party payment structure where consumers and employers purchase insurance coverage in exchange for premium payments to insurance companies. Patients receive healthcare services from medical providers. Medical providers bill insurance companies for the cost of healthcare services provided to the insured patients. So, the financial transaction for the specific healthcare service is between the insurance company and the provider, not the patient, other than any out-of-pocket expenses they may pay. Third-party health insurance can be either private or public, meaning state and federal government acts as the insurer. We are going to look at the third-party mechanism, its impact on each stakeholder, specifically the consumer, the provider, and the insurer. The advantage of insurance is that it allows for risk to be spread over a large pool of people. This provides peace of mind for the patient, especially those with high healthcare costs. It is important to remember that insurance redistributes cost, but does not eliminate or reduce it. Medical providers also benefit from having a well-established and well-capitalized insurer responsible for payments so that they have much more confidence that they will actually get paid and don't have to go chasing after individual patients for payment. Insurers are experts in managing risk and earn a profit margin for that expertise. The third-party payment structure, however, results in the consumer or patient being shielded from most of the financial transactions related to the purchase of healthcare services. With the medical professional making decisions on behalf of the patient for which services and where to receive those services, the patient does not have an incentive to act as a consumer who is seeking value. The patient relies on the medical provider to tell them what services are needed, and they also rely on the insurance company to pay for those services. To provide more context, let's review a familiar example. To help contextualize this a bit, let's look at Janet. Janet has a job at XYZ Corporation that provides her health insurance with a monthly premium cost of $500. XYZ pays 80% of the premium cost, or $400 per month, and Janet only pays the remaining 20%, or $100 per month. Janet breaks her leg skiing and has to go to the hospital to have surgery to have it repaired. The total cost for all of the healthcare services provided to her is $15,000. Her insurance coverage pays the entire amount after Janet pays her $500 deductible upfront. That means that $14,500 in bills for the hospital, surgeon, and anesthesiologist are all paid for by her insurance company. We can certainly see the value of the insurance and risk pooling here, where Janet's cost of $15,000 far exceeds the cost of her insurance coverage at $6,000 per year. In the absence of insurance, Janet would be paying the entire bill out of her own funds, which in many cases would cause severe financial strain and potentially uncollectible funds to the provider.